one of the greatest refinances that you want to be listening to.
Multifamily here started, 120 years ago.
Yeah.
In Chile started 15 years ago.
Like how he structured his deals, how did he do his first deal, dissect one of the deals that you were mentioning.
We bought it for 1.9 million. If you miss one of the terms, the penalties are high.
Very high. You're almost at 100 plus doors, right? We'll get
129.
129 doors.
That
So you
was-
bumped the value of a property from 1.9 million to 5.6 million.
Yes.
CMHC MLI Select, I'm sure you guys know about this. They give up to 50-year amortization, up to 95% loan to value. Good morning, everyone. So today we are with another episode. I'm joined here with Mr. Alvaro, and today we are going to be uncovering about one of the greatest refinances that you want to be listening to in terms of buying a multifamily and pulling most of your capital out or everything out. And so thank you, Alvaro, for joining us today.
Thank you for having me.
Of course. And so for all the viewers out there, if you want to kickstart and tell us a little bit about yourself, your journey. Obviously, you're brand new to Canada, as I want to say, right? So if you want to give us a quick elevator pitch of your background.
Yeah, of course. I'm from Chile. I'm a lawyer. I used to be a corporate lawyer. I arrived to Canada 5 years ago. It's going to be 5 years in October. I moved here basically because I feel very attracted about the North American real estate industry.
Mm-hmm.
It's complex, it's very diverse. There is a culture here that I don't have in my country with the private lending dynamic that we don't have.
Right.
It's very, very interesting. It's always hard to find money, but I think it's easier than back home.
Yeah, of course.
So I used to live in Montreal for almost 2 years. 3 years ago, we moved to Calgary.
Nice.
I targeted the destination.
The switch to Calgary, a lot of investors invest in Alberta in general, right? So the switch to Calgary, sorry to cut you off, is it because of just the real estate market? Like you see numbers working here better?
Yeah, because I'm kind of a nerd, so I started studying the Alberta regulations regarding landlord-tenant relationships. I think are more pro-investors. Also, the tax structure makes much more sense to me here than in the East, for example. It's never easy to do real estate investing, but I think here everything is set up for you as an investor to thrive if you do the work.
Absolutely.
That's what I like.
No, for sure. So, in terms of your background, you said you were a lawyer yourself, but you're absolutely fresh into real estate.
No.
No? Okay.
I started in 2010. I had single-family homes in Chile.
Okay.
I still own land for development.
Nice.
But here, the scale you can achieve in less time is much more attractive to me.
Yeah. No.
And multifamily here started, 120 years ago.
Yeah.
In Chile started 15 years ago.
Yeah.
So it's more like an investment fund or bank or retirement fund kind of thing.
Much more renewables. And I also think I like the fact that you mentioned about the private financing or lending side of things. One thing, I'm from India myself. One thing I've noticed is North America in general, just the financing options are very diverse.
Exactly.
So if we are smart enough and if we position ourselves, we can really take advantage of the market.
Oh, absolutely.
Right.
And because nobody knows you at the beginning.
Yeah.
Well, it's like on any other job, if you're professional,
Mm-hmm.
if you're consistent, if I say to you that I'm going to call you tomorrow at 5, I'm going to call you tomorrow at 5. If I cannot call you, I'm going to let you know.
Yes.
But it's the small things.
Yes,
you see?
absolutely.
It's doing things properly, being consistent, and I'll always be available to talk to anybody if you're in trouble or not.
Right.
I'll always be there.
Of course. So one thing you guys, very interesting thing is Alvaro being here 5 years now, or let's say you're almost at 100 plus doors, right? We'll get
129.
129 doors. And then a lot of people say that the Canadian dream, or it's very hard to get into real estate, but here's a living example. So we really wanted to jump right into it in terms of how he structured his deals. How did he do his first deal? In fact, let's just maybe dissect one of the deals that you were mentioning about
absolutely.
the Rocket Ridge.
Well, I have two partners. It's the best partnership I ever have, I think. The three of us have very different skill sets, so we complement each other very good. I'm not good at what my partners do. They are very good at stuff that I don't do.
Teamwork.
So it's a really a team effort. Especially, I value they are very professional, very serious, hard workers. But I really value that we're not afraid. We're careful. We are very cautious. We don't take unnecessary risk. But if some trouble comes along, or if we find something that is pretty difficult, we just get together and find a way out.
Yeah.
Especially for the investors, because at the end of the day, your clients are your investors.
Yes.
And if you're good to them, they're going to be good to you. So that's basically
Long-term relationship is key, right? And then you said one of your partner was a construction guy.
Yes.
Yeah.
Remy Noel, he's from Edmonton. He's a contractor. He owns a contracting company.
Right.
He knows a lot about construction. He's in charge of all our renovations. He deals with the reports guys. He do the numbers. He's very quick at realizing how much is going to be necessary to invest to put an asset in shape.
Right.
Or not to invest.
That's kind of his expertise. He just looks at the assets, tells you like how much it's going to take to stabilize the unit.
But he has like a very business-oriented mind.
Yeah.
So he can see the business beyond the construction. He's
right.
Not every contractor that I know is like that.
Yeah, of course. And it's also something like, like you just want to make sure like within your team, as much as everyone complements each other's strength and weakness, like you just have to, like on a high level, just be able to communicate better, and then just understand the numbers better, and then the vision, the goals has to be aligned. That's just it. So like, why don't we just break down the numbers on your first deal that you did, and that was a great deal, you guys. So he pulled out most of his capital, if not more. So we're gonna discuss some numbers now.
Well,
the interesting part.
My other partner, Rodrigo Parada, we started almost 3 years ago. He's from Chile. His dad is from Chile. His mother is from El Salvador. So we have the same bad words. It was kind of funny. He's very good at numbers. He's our numbers guy. To the business strategy, he's very good at that. So I'm going to try my best. Okay.
Okay. Yeah. Let's do it. Yeah.
We found this. Our first project was 38 units in Rocky Mountain House. That's 2 hours northwest of Calgary.
Yeah.
It's a 7,000 people, 7,200 people town, but it has certain characteristics that makes it very attractive. So they have all the big box stores. They have a lot of storage. They have a lot of, they have these huge dealers that sell trucks and agriculture equipment. It's like it's a small town, but they have everything.
It's diverse.
It's very diverse. The location is also key. They are in the intersection of two major highways, so all the forestry industry goes through there when they go to BC. The gas industry use that road also, so it's not just a 7,200 people town. They have a very big hospital that is very close to our units. So we started. We were nobody knew us. We have experience. Rodrigo had some experience in Montreal. He owned like 20 units.
I see. Okay.
Smaller buildings with his family. He had that kind of experience, but 38 was much more. And nobody knew me really in Alberta. I have, since from I was living in Montreal, I started doing networking to Alberta before moving, but I wasn't from here, so nobody knew if I was a crook or a decent guy.
Yeah.
So we start knocking on doors.
Right.
We started working with a broker. He went to 5 different lenders. 4 of them say no. 1 of them say yes. So we didn't have any sort of negotiation room, anything. We had to say yes to everything they asked. And we bought it for 1.9 million.
Yeah.
So that's $50K a door. It was pretty good.
50. So how many units was it?
38.
38 to 2 buildings side by side.
2 buildings side by side. It's 20 in one and 18 in the other. They were old and dated, but they weren't that bad. We had 57% vacancy. So we had like 15 or 16 units occupied. It was absurd. So nobody wanted to touch it. So these guys with no experience, no tenants and everything were asking for a loan. We started working with this lender that was very good to us. And we met Remy like 3 months after. We became partners after that, the three of us.
Nice.
And he started the renovations in January 23. It was challenging because we didn't have any money or very little money, and you require money to start purchasing materials and paying the guys that were working over there. And after that, you send the invoices to the lender, and they give you a refund. You have to put some money up front.
You were telling me the lender, so your purchase price was 1.9 million, and then obviously it was a struggle to find a lender to fund it. First, you guys are new. Secondly, it's a smaller town. And then the property was about 50% vacant, you were saying?
57% vacant. We raised $988,000, and I think $800,000 out of those were RSPs. We tried four different ways of cashing those RSPs. We ended up having to get a bridge loan from friends and family. So we had to raise the money twice to close on it.
Right.
And then we started the MFT out of necessity, not because we're so cool.
Yeah.
So that was the way we found to cash all the RSPs and make the deal. It was an adventure.
Yes, of course.
So renovation started. We started with the empty units. It was easier, faster. It was in the middle of the winter, so it was slow.
Right.
But we renovated 32 out of 38. But the other 6 we did like minor stuff. It's not that we didn't touch them. Some of the tenants left because we raised the rents. The rents were very low. And some of the units were in very poor state because those people, they didn't want to get evicted or a raise in the rent, so they
probably have been living there for many years too, right?
Yeah. And they were like in a very poor state. Remy did a fantastic work. Me and Rodrigo were like in behind, cashing the money and doing this and that and talking to the banks and whatever. In September 24,
So about a year.
About a year later, yes, we had an appraisal for $5.6 million.
Wow. Yeah.
So
you bumped the value of a property for 1.9 million to 5.6 million.
Yes, basically investing 3. Because with the closing cost and the
renovation, you
like
probably
3.
spent another $1 million on it.
$1 million renovations, yes.
Nice. And then so you're all in at 3 million, let's say, and then you have an uplift of almost 2.6 million.
Yes.
Just because of the renovation you did and placing the right tenants in there.
Yes, it was a lot of work. We hired property managers, a very good company from Edmonton, 20 years experience. This is a tertiary market. It's 2 hours away from Edmonton, so it wasn't easy. And we had to find like a resident manager, somebody to show the units because it was empty. And we were finding tenants as we were finishing units. So we had them vacant for the less amount of time.
Yeah.
This lender gave us like a bridge loan.
Yeah.
So we got appraised at 5.6 in September. We went straight to MLI Select with another broker. We changed the broker.
So when you say the bridge loan, like what interest rate did they offer you initially for the construction, like for the lending?
I think it was like 10%.
It's expensive.
Yeah, it's very expensive. And the terms are very. You have to be very disciplined and very organized because if you miss one of the terms, the penalties are high.
Very high, yeah.
It was our first deal, the first lender who wanted to work with us, so we just say yes.
You got to be thankful to them, yeah.
Very thankful.
Yeah.
And we switched brokers to a young guy in Ontario that we still work with him.
Nice.
Very, very good, very proactive. He's always chasing us for some paper.
Nice. Yeah, you need those kind of brokers, yeah.
Yeah, you need those because you're too busy doing your own work.
Correct.
And you cannot do the other guy's work as well.
Absolutely. So you appraised the value of 5.6 million, you stabilized the unit, repositioned it, and then you went to CMHC MLI Select.
Yes.
Now, CMHC MLI Select, I'm sure you guys know about this. They give up to 50-year amortization, up to 95% loan to value. There's affordability criteria, energy efficiency criteria, and accessibility criteria that they go based on. It's a point system. And now, so how are you? Did you guys go all the way to 50-year amortization and pull out all the money out with a 95% loan to value, or?
At the beginning, we started with the energy efficiency strategy. It was not easier, but it was simpler. And you don't have the constraints of the affordability, and accessibility was more complicated, so we didn't want it. But in June last year, CMHC suddenly changed the rules.
Yes.
And you have to choose two out of the three.
Mm-hmm.
So we went with affordability. So basically what we did is we take 10% of the units, the smallest ones. We put them under the
affordability cap.
Yeah, the affordability cap, I think it was 1135.
Yeah.
We put it at 1125, something. They also cap the amount you can raise every year, but it's fine for 10 years. So that gave us 20 points.
Okay.
Then we go with the energy efficiency. And because you learn as you go,
yes,
we realized, talking with a couple of engineers, that in Alberta it's very difficult to get the 100 points out of energy efficiency because we don't have hydro energy here. In the east they have hydro, so they can go 100.
Here we need oil.
We need gas to produce electricity, so
Yeah.
it was more complicated. So we used the 20 points using 10% of the units affordable and 50 points going 40% energy efficiency.
Nice. Okay.
And with those 70 points, we were able to get this 95% LTV that we were looking for.
Nice.
Because it wasn't 100 point, we weren't able to go 50 years amortization, but we got 45. That is pretty similar.
Yeah. Not as much big difference. And then the other thing is that with the energy efficiency, you were telling me earlier, like you didn't have to go change windows and such, but you did low flow toilets, shower heads, all the faucets and everything.
LED lights.
LED lights.
The most expensive item, but at the end of the day, you also save money because we had the boilers, the existing boilers were okay. They were like 10, 12, 14 years old. They weren't that bad, and they were maintained, but they were not high efficiency. So we changed them. It was 4 boilers. We spent around $60K per building. It wasn't cheap, but the energy consumption now is like 50% of what used to be. So I think in a couple of years, 2, 3, or 4 years, we're gonna to amortize that investment. So no, it was a very interesting experience.
So you basically at 5.6 million with a 95% loan to value pulled out all your investment, initial investment,
yes,
plus a bit of profit.
Yes, that was the most rewarding part to us because, again, with the investors, these people believed in us when we were nobody.
Yes,
they were willing to trust in us when we have no track record or a way to show that we were capable of doing this.
Right.
So we were able to return their investment in 14 months plus almost 38%
returns on the capital
returns
invested.
on the capital to them.
So you pulled out what, $1 million?
1.8 million, I think.
Wow, amazing. That's a great deal.
A little more. No, a little more because I don't remember the exact number, but I remember that it was appraised at 5.6 and we got financing for 5.3.
Up to 5.3 million. Yeah.
95% LTV.
Right.
So we paid the lender everything.
Who's the lender on it? So you got the CMHC MLI Select, CMHC insurance. I'm curious to know who's the lender.
For the bridge or for the definitive one?
For the refi.
For the refi was People's Trust.
People's Trust? Okay.
Yeah.
Okay, I see. Now, so that was your first deal that you did. Now, fast forward now, what are you working? How do you see yourself in the next 2-3 years? Question though, like, CMHC MLI Select always keeps changing their regulations and such. Now, like, do you have any insight on how long or will they pull the plug on this whole program? Where are we looking at?
Well, there is always like rumors in the market that they're going to change this or that they're going to change that. But I think you have to get comfortable being uncomfortable.
Yeah.
This market is constantly changing. If it's not CMHC, is the provincial regulations, or is the, I don't know, the immigration stopped, so you don't have the same flow of people coming in.
Right.
Rents go down. So you have to be open to be very flexible, very adaptable. I know people that lost a lot of money in Ontario because of the change of the regulations. Thankfully, we were able to adjust in time.
Right.
But when in trouble, the three partners, we get together and look for an exit, because it's basically, again, it's about your investors, it's not about you.
Yes.
If you want to build a sustainable business that lasts like for decades, you have to start doing things properly from the get-go.
Absolutely, absolutely. Now, so fast forward now, like you were saying, like you're also getting into the new build space, and then, but like new builds, you're not technically getting a big uplift, a force appreciation like the ones that you're getting in older buildings that you've.
No, that's the thing.
On.
So we realized that everybody, because new builds are so nice. Everything is brand new. Everything works.
Less maintenance.
Everything is clean.
Yeah.
The paint is new. It looks so nice. But at the end of the day, we realized that we were doing very good with old stuff.
Yeah.
It's maybe we're going to be doing new builds in the coming years, but for now, our strategy is buying old stuff.
Right.
We bought 24 units in Camrose that were new, but we bought them when they were 85, 90% completed.
Right.
So we didn't have the development risk of the, I don't know, of the permits, of the increase of cost or this and that.
Almost done already.
So because it was almost done, we knew the builder, we knew the realtor that was working with him. He was a very, very good partner. He stayed with us with a percentage of shares.
Nice.
So we negotiated with him in exchange of a lower down payment.
Right.
We recently acquired, he's building 12 more units on the other side of the street, like in front of the building. We use the reserves we have, asking permission first to the investors to put those reserves as a down payment for the 24. So
it's a bit risky.
No, because we already have cash flow.
That's true, yeah.
So we have our backs covered, but pretty much the investors with the same investment, they purchased 36 instead of 24. They were very happy.
Amazing. So now, like someone who's getting into real estate, right? Like who wants to reposition the buildings and apartment, like they always are like, hey, if I go to a smaller town, there's a lot of risks, right? And then like especially let's say if there's a downtown in one big industry, which the small town go basis off. So are you also like, do you only go for towns which has some sort of diverse market, or so let's say Brooks, Alberta, right? Like Brooks is just a meat plant, just basically runs it, and if it shuts down. Yeah, exactly. So would you still go into those kind of market, or would you try to stick to, even if it's a smaller, it has to be a diverse market?
For example, and this is just us.
Yeah.
But we try not to go northern Edmonton.
Okay.
I think northern Edmonton is very cold, especially the winters are very harsh.
Yes.
So you have less people going there. Maintenance is hard because of the temperatures.
The winter.
Also, we always try to find towns, because secondary and tertiary markets are great, but you have to know how to pick them.
Yeah.
You don't want to go to a certain town that has only one source of income.
Right.
I don't know, for example, an oil-based town. When oil is thriving, you're doing great.
Yeah.
But when the price of oil goes down, you go down with it. So, for example, in Rocky Mountain House, there is a lot of agriculture. There is some gas industry. There is forestry. So we know we have a very diverse source of income.
Market. Yeah. Amazing. So that's one thing. Like it has to be diverse, as you were saying. Like if it's just one market goes up, you're going with it. You don't have control on the property whatsoever, right?
And you always have to. Well, you're a car guy like me. So when I buy a car, even if I don't have it yet, I'm always thinking when I'm going to sell the car.
Yes.
So this thing sellable?
Mm-hmm.
Is it in good condition? What can I do to improve the value? So
Yes.
Before you even buy the building, you have to have like an exit strategy. What do I have to do if I want to sell it?
Yes.
It's going to be easy. It's going to be tough. You
Mo-
have to have all that in your.
Yeah, especially with multifamily. I mean, it's obviously that two exit strategies. One is like you can reposition and sell it to a bigger investment firm, or you can just keep it as long as
Yeah.
it cash flows, kind of thing. Is there anything else that we should add to this session here?
I don't know.
Yeah.
It was very fun.
Yes, of course. So thank you guys for watching. So today there was absolute golden nuggets in here. Even now in this market, we are able to find properties that you can actually buy, reposition it, increase the rent, renovate it and all that, and refinance and pull a chunk of money out, use that capital, which is tax free, get into a next investment and keep on doing it. And Alvaro shared some golden nuggets. And if you have any questions further, you can reach out to me or Alvaro. I'll drop all the information in the YouTube description below there. And thanks a lot for sharing all the information. And thanks a lot
Thank you
for
for
your
the
time.
invitation, Hafil.
Of course. And thank you guys. And we'll see you on the next one. See ya.
Bye.